Before we dive in, please remember that I am not a licensed financial advisor, and the information in this presentation is for educational and informational purposes only. This video is not intended as a substitute for professional financial advice. You should always consult with a qualified and licensed professional before making any decisions about your financial future or insurance needs. The scenarios discussed are illustrative, and individual results will vary. I'll never forget the phone call. It was from a woman named Sarah, and she was whispering, trying not to let her kids in the next room hear her crying. Her husband, Mark, had passed away 2 days earlier after a sudden heart attack. He was only 58, and Mark had done what he thought was the right thing. He had a $500,000 life insurance policy through his job. He'd always told Sarah, "Don't you worry. If anything ever happens to me, you and the kids will be taken care of." He thought he had protected his family. He thought he had left a legacy of security. But when a grieving, shell-shocked Sarah called the funeral home to make arrangements, they gave her the bill, $12,000. And they told her they needed at least half of that, $6,000, by Friday to even begin the process. So, Sarah called the life insurance company, the big, well-known company Mark worked for. She explained the situation, her voice trembling, and the agent on the other end of the line was very polite, very sympathetic. He said, "Of course, Mrs. Johnson, we're so sorry for your loss. We just need you to fill out these claim forms, and we'll need a certified copy of the death certificate." Sarah asked how long that would take. The agent paused and said, "Well, once we receive all the completed paperwork and the official death certificate, which can take a few weeks to get from the state, our standard processing time for a claim of this size is typically 6 to 8 weeks. 6 to 8 weeks. The funeral was in 5 days. The bill was due on Friday. The $500,000 Mark had promised his family was locked away behind a wall of corporate red tape, paperwork, and processing delays. That so-called protection was useless for the most immediate, most painful, and most urgent expense her family was now facing. Sarah was on the phone with me, a complete stranger, asking through her tears, "What do I do? He promised we'd be okay. Where am I supposed to get $6,000 by Friday?" That phone call is the entire reason this video exists. Because millions of Americans right now are in the exact same position as Mark. They have life insurance. They think they've done the right thing. They believe they've protected their families from financial hardship. But they are living with a dangerous illusion, a critical blind spot in their planning that will leave the people they love most in a world of financial pain at the absolute worst moment of their lives. In this video, we are going to pull back the curtain on one of the most misunderstood, and frankly most important financial tools that exist for American families: final expense life insurance. And I'm not just going to give you a dry definition. We are going to expose the real meaning of this protection. We're going to dismantle the common myths. We're going to highlight the hidden traps in traditional insurance policies that leave families like Sarah's stranded. And I'm going to give you a clear, simple roadmap to ensure your final wishes become a legacy of peace, not a legacy of debt. By the end of this presentation, you will know with 100% certainty how to make sure your loved ones get cash in hand in days, not months. You will understand how to bypass the red tape and protect them from the stress and the humiliation of having to ask for money or start a GoFundMe just to pay for a dignified farewell. Let's be brutally honest for a minute. Nobody wants to think about this stuff. But the reality is, the end of life has become a big business in America, and it is an expensive one. The National Funeral Directors Association reports that the median cost of a funeral with the viewing and burial is now over $9,000. And that's a national median. In states like New York or California, you can easily be looking at $15,000 or more. And that's just the funeral. That figure doesn't include the cemetery plot, the headstone, or the cost to open and close the grave, which can add thousands more. It doesn't include the mountain of final medical bills that come after even a short hospital stay. It doesn't include credit card debts, car payments, or utility bills that all come due. The total cost of dying in America can easily reach $20,000, $30,000, or even $50,000. And all of those bills demand to be paid immediately. The funeral home doesn't offer a 30-year mortgage. The hospital's billing department doesn't care that you're grieving. They want their money, and they want it now. This creates what I call the payout gap. It's the dangerous, financially treacherous period of time between the moment a person passes away and the moment their large life insurance policy actually pays out. It's a gap that can last for weeks or even months. And into this gap fall grieving families, spouses, children, grandchildren who are forced to drain their own savings accounts, rack up high-interest credit card debt, or even take out personal loans just to cover the immediate costs. This is the exact opposite of what you want your life insurance to do. You bought it to relieve their burden, but because it's the wrong kind of tool for the job, it inadvertently adds to it. Think of it this way. You wouldn't use a sledgehammer to hang a picture frame, would you? And you wouldn't use a tiny tack hammer to demolish a concrete wall. They are both hammers, but they are designed for completely different jobs. Traditional life insurance, like that $500,000 policy Mark had, is a sledgehammer. It's designed for the big, long-term jobs, replacing a decade of lost income, paying off a 30-year mortgage, funding a child's college education. It's a massive, powerful tool meant to rebuild a family's long-term financial foundation. And because the dollar amounts are so large, the insurance companies have a very thorough, very slow, and very deliberate process for paying out those claims. They have to investigate, verify, and process everything meticulously. Final expense insurance is the tack hammer. It's not designed to rebuild the whole house. It is a small, fast, precise tool designed for one specific urgent job, to cover the immediate costs associated with the end of life. Funeral bills, medical copays, legal fees. We're not talking about $1 million here. We're talking about policies that are typically $5, $10, $20, maybe $50,000 in size. And because the purpose is speed, the entire product is built differently from the ground up. The application is simpler, the underwriting is faster, and most importantly, the claims process is designed to pay out in 24 to 48 hours, not 6 to 8 weeks. It's designed to put a check in your family's hand before the funeral bill is even due. Closes the payout gap. It ensures that your family's first memory after you're gone isn't one of panic, of scrambling for cash, of feeling like you let them down. What we're going to explore is how this simple shift in understanding, choosing the right tool for the right job, is the key to true peace of mind. It's the difference between leaving behind a complicated financial puzzle for your loved ones to solve while they're grieving, or leaving behind a simple, elegant solution that works exactly when they need it most. So, what is the fundamental difference? What is this tool that can bypass the weeks of waiting and put money into your family's hands in as little as 24 to 48 hours? It all starts with understanding one simple, powerful concept that the big insurance companies rarely talk about: the assignment of a beneficiary. That's it. That's the concept. It sounds almost ridiculously simple, doesn't it? The assignment of a beneficiary. But within those 4 words lies a universe of difference between financial security and financial ruin for the family you leave behind. To understand this, I want you to meet Sarah. Sarah and her husband David were the picture of responsibility. They did everything right. They saved for retirement, they paid down their mortgage, and David, being the planner he was, made sure he had a life insurance policy. A big one. A $500,000 term life policy. He'd sit at the kitchen table, look at the policy documents, and tell Sarah, "If anything ever happens to me, you and the kids will be taken care of. You won't have to worry about a thing." And Sarah believed him. She had a copy of the policy tucked away in their filing cabinet, a $500,000 promise in black and white. It was their ultimate safety net. Then the unthinkable happened. David had a sudden massive heart attack at 62. One minute he was planning their summer trip to see the grandkids, the next he was gone. In the blur of grief and shock, Sarah remembered David's words. "You won't have to worry about a thing." Amidst the pain, there was a tiny sliver of relief. At least the finances were handled. At least she wouldn't have that burden. She was wrong. Terribly wrong. The first call was to the funeral home. The director was kind, compassionate, but he was also running a business. The service they planned for David, a simple, dignified farewell, was going to cost $12,000. He gently explained they'd need at least half of that up front to begin the arrangements. Sarah took a deep breath. "Okay." She pulled out the life insurance policy. "My husband has a $500,000 policy," she said, her voice shaking slightly. "The money should be coming soon." The funeral director gave her a sad, knowing look. He'd seen this play out 100 times. He explained that while it was great she was the beneficiary, life insurance companies don't just write a check the next day. There's a process. The next day, Sarah called the insurance company. She sat on hold for 45 minutes, listening to cheerful piano music that felt like a cruel joke. When she finally got a representative, they were polite but firm. They needed an original, certified copy of the death certificate. Not a photocopy. An original. And they would mail her a packet of claim forms. She'd need to fill them out, get them notarized, and mail them back. Then, their claims department would review everything. The timeline? Typically 4 to 6 weeks, ma'am. sometimes longer depending on the circumstances. 4 to 6 weeks. The funeral was in 5 days. The mortgage payment of $2,000 was due next week. The car payment, the utility bills, the credit card bills, they weren't going to wait 4 to 6 weeks. Panic began to set in. Real cold, terrifying panic. She had some money in their joint checking account, but not nearly enough to cover a $12,000 funeral and all the regular bills. Their savings were tied up in accounts that were now frozen because they were in David's name. This is the dirty little secret of traditional life insurance. That $500,000 policy wasn't a checkbook. It was an asset. It was part of David's estate. And before an estate can be settled, everything has to go through a legal verification process. The insurance company has a legal duty to make sure they are paying the right person, that there are no other claimants, that all the I's are dotted and T's are crossed. They have to protect themselves from fraud and lawsuits. So they wait. They wait for official documents. They investigate. They process. And while they process, the world of the grieving family doesn't stop. The bills keep coming. The financial pressure mounts with every passing day. Sarah's story isn't unique. It happens every single day in America. Families with a 6- or 7-figure life insurance policy in their name are forced to borrow money from relatives, run up credit card debt, or even take out high-interest loans just to pay for a funeral. They have the promise of money, but they don't have cash. And that is the entire purpose of final expense life insurance. It's not about replacing a person's income for the next 30 years. It's not about paying off the entire mortgage or funding a college education. It is a specific specialized tool designed to solve one problem and one problem only, providing immediate, unrestricted cash to your family within 24 to 48 hours of your passing. Think of it like this. A big, traditional life insurance policy is like a wire transfer from an international bank. It's a large sum of money, but it has to go through compliance, verification, and multiple processing stages before it ever lands in your account. It's secure, but it's slow. A final expense policy is like having a key to a safe in your living room. Inside that safe is $10, $20, maybe $30,000 in cash. When the emergency happens, you don't fill out forms. You don't wait for approval. You walk over, you turn the key, and you get the cash you need right when you need it most. How does it work so fast? Because the entire product is designed for speed. The death benefits are smaller, typically between $5,000 and $50,000. This smaller amount means the risk to the insurance company is lower, so the claims process is radically simplified. They still need a death certificate, but because these policies are almost always whole life policies with a named individual beneficiary, not an estate, they bypass the entire legal nightmare of probate court. Probate is the legal process of validating a will and settling an estate. It can take months, sometimes even years. And any asset, including a life insurance policy paid to the estate, gets locked up in that process. But a final expense policy with a named beneficiary, like a spouse or a child, is a direct contract between the insurance company and that person. The money flows directly to them, a private transaction that probate court never even touches. So when Sarah needed $12,000 for David's funeral, she was trying to use an estate settlement tool for an immediate cash emergency. It's like trying to put out a kitchen fire with a fire hose connected to a hydrant a mile down the street. By the time you get the water flowing, the house has already burned down. What she needed was a fire extinguisher mounted right there on the kitchen wall. That fire extinguisher is final expense insurance. It's for the funeral. It's for the burial or cremation. It's for the last month of medical bills that will inevitably show up in the mail. It's for the plane ticket for a child who needs to fly home to say goodbye. It's for keeping the lights on and the mortgage paid during those first few chaotic months while the larger estate is being sorted out. It's not a replacement for a big life insurance policy. It's the critical first response tool that works alongside it. Provides peace of mind, yes, but more importantly, it provides dignity. The dignity for your family to grieve without the added terror of financial collapse. So if this tool is so powerful, so logical, so necessary, why isn't it the first thing every insurance agent talks about? Why does it feel like some hidden secret? The answer is both simple and infuriating, and it has everything to do with 3 fundamental myths that the financial industry has been quietly feeding the American public for decades. Myth number 1: life insurance is a rich person's game. It's for estate planning, tax shelters, and transferring generational wealth. You see it on TV, right? The wealthy patriarch in the mahogany-paneled office, discussing his multi-million-dollar policy with a slick advisor in a $1,000 suit. The message, whispered over and over, is that this is a tool for the 1%. And for everyone else? Well, you're supposed to just save a little here and there and hope for the best. This is, without a doubt, the most successful and damaging lie the modern financial industry has ever sold. Because it's a complete reversal of the truth. Life insurance wasn't invented for the rich. It was invented by the working class for the working class. Think about it. 150 years ago, if a coal miner or a factory worker died, what happened to his family? There was no social security, no pension, no 401k. They were destitute. Instantly. So, communities, churches, and fraternal organizations created something called a burial society. Every member would chip in a few pennies a week into a common pot. And when one of their own passed away, the money was there to pay for a dignified funeral, and to give the widow a little something to survive on until she could find work. That was it. That was the birth of life insurance. It was a promise between neighbors. A promise that no matter how hard life got, no one would be left to face the final bill alone. It was the ultimate community safety net. It was never about yachts or vacation homes. It was about a pine box and a headstone, and not leaving your children with a debt they couldn't pay. The financial industry took this beautiful, simple concept, neighbors helping neighbors, and they wrapped it in layers of complexity, jargon, and intimidation. They made it seem like you need an advanced degree in finance to understand it. Why? Because complex products for the wealthy have massive commissions. Simple, affordable policies for everyday people? Not so much. They've convinced millions of hardworking Americans that the one tool designed specifically for them is something they shouldn't even be looking at. It's like telling a carpenter he's not allowed to use a hammer because it's a tool reserved for architects. It's absurd. This brings us to the second, and perhaps more insidious myth. Myth number 2. If you save responsibly, you won't need life insurance. You'll be self-insured. This is the mantra of a lot of popular financial gurus. They tell you to invest in the stock market, build up your nest egg, and by the time you're 65, you'll have a mountain of cash so big that a $10,000 or $15,000 final expense will be a drop in the bucket. And on paper it sounds fantastic. It appeals to our sense of independence and responsibility, but it ignores one brutal, inconvenient reality: the difference between wealth and cash. You might spend 40 years building up a respectable net worth. You have a paid-off house, a healthy 401k, maybe some other investments. You are, on paper, self-insured. Then the unexpected happens. You pass away. The funeral home director, a very kind and sympathetic person, presents your grieving spouse or your children with a bill for $12,000. He's not a villain. He runs a business. He has employees to pay, taxes, electricity bills. He needs that money, typically within 30 days. So your family looks at your assets. There's the 401k. To get cash out of that, they have to navigate a maze of paperwork, prove they are the rightful beneficiary, and then deal with the massive tax implications of the withdrawal. This isn't a 24-hour process. Can take weeks, sometimes months. And every dollar they pull out is taxed as income. That $12,000 bill might require a $20,000 withdrawal just to cover the taxes. Then there's the house. It's worth $300,000. Plenty of money there. But the house is not cash. It's brick and wood. To turn it into cash, they have to hire a realtor, clean it out, maybe make some repairs, stage it, list it, show it, wait for an offer, negotiate, and then wait another 30 to 60 days for the sale to close. All while the funeral director is calling, politely at first, then more firmly. The pressure mounts. The grief is overwhelming. And what do people do under that kind of pressure? They make bad decisions. They take the first lowball cash offer that comes along just to stop the bleeding. They sell your home, the place filled with a lifetime of memories, for 80 cents on the dollar because they needed cash and they needed it now. Your self-insurance plan, your paper wealth, became a trap. It forced your loved ones to liquidate your life's work at a fire sale price, all to cover a relatively small immediate need. A final expense policy isn't about your net worth. It's about liquidity. It's about having a check, for a guaranteed tax-free amount, show up in the mail within days. It's a financial first responder. It arrives instantly and solves the immediate crisis, allowing your family the time and the breathing room to handle the rest of your estate with wisdom and care, not out of panic and desperation. The idea that savings can replace this function is like thinking a pantry full of food can replace a fire extinguisher. When the house is on fire, you don't need a 5-course meal. You need to put out the flames right now. Finally, we arrive at the myth that causes the most paralysis. the one that makes good people throw their hands up in defeat. Myth number 3. I'm too old or too sick to qualify. Or if I can, it will be so expensive it's not even worth it. This is the knockout punch for so many. They've spent their whole lives hearing that you're supposed to buy life insurance when you're young and healthy. They've seen the ads with 20-somethings rock climbing. They get to their 60s or 70s, maybe they have high blood pressure, diabetes, or beat cancer a few years back. And they think, it's too late for me. That ship has sailed. And if we were talking about those massive million-dollar term life policies, they'd be absolutely right. The insurance companies would take one look at their age and medical history, and either deny them outright or quote a premium that costs more than a mortgage payment. But this is the secret the industry doesn't want to shout from the rooftops. Final expense insurance is a completely different world. It was built from the ground up for this exact person. It was designed for seniors. The insurance companies who offer these policies know you're not 25. They expect you to have some health issues. That's why the underwriting is so different. For many of these plans, there is no medical exam. You don't have to go to a doctor and have someone draw your blood. There are no needles. It's just a simple application with some health questions. And for those with more serious health conditions, there are even policies with no health questions at all. They are called guaranteed issue policies. If you are within the eligible age range, typically 50 to 85, you cannot be turned down. Period. Think about how profound that is. An industry that is famous for judging you on your health has created a product that says, your health doesn't matter here. Why would they do that? It's a numbers game. They know that by insuring a large group of seniors, the risk will spread out. And these policies are not for $1 million. They are for smaller amounts, $5,000, $10,000, $20,000, specifically designed to cover the costs we've been talking about. They are built for a purpose. Because the death benefit is smaller and the risk pool is predictable, the premiums are kept affordable, often fitting into a tight budget for someone on a fixed income. The belief that you are uninsurable is the final gate the industry uses to keep people out. They let you believe that because you can't qualify for the products they make the most money on, you can't qualify for anything at all. But behind that gate is a whole world of options designed precisely for you, waiting to provide that final act of love and protection. These 3 myths, woven together, create a powerful narrative of exclusion. They tell you it's not for you, you don't need it, and you can't get it anyway. It's a story designed to make you feel powerless. But breaking down these myths is the first step. Understanding the truth is how you take that power back. And that power isn't just about money. It's about peace of mind. But where does that peace of mind truly come from? It's not just from a check. It's from understanding the one thing that a funeral director fears more than anything else: an informed consumer. A family that walks through the door not with a blank check and a broken heart, but with a plan. Piece of paper. That's it. A single piece of paper is the most terrifying thing in the funeral industry. Why? Because the entire business model for a century has been built on a foundation of 3 things: grief, guilt, and confusion. When you are at your absolute lowest, when you can barely think straight, you are walked into a quiet, softly lit room and presented with a series of choices you are emotionally and psychologically unprepared to make. Think about the last time you bought a car. You probably spent weeks, maybe months researching. You read reviews, compared prices online, and walked onto the lot armed with information. You knew the invoice price, the interest rates, the trade-in value of your old car. You were in control. Now imagine doing that 30 minutes after learning your mother has died. Imagine trying to negotiate the price of a casket when you can't stop the tears from rolling down your face. It's impossible. The industry knows this. They depend on it. That quiet room, often called the selection room, is one of the most brilliantly designed sales environments on the planet. Let's walk in there together. You're greeted by a funeral director, a kind, somber man or woman who speaks in hushed, comforting tones. They're not monsters. Most are good people, but they are running a for-profit business. They guide you into the room. And what's the first thing you see? Right at eye level, gleaming under a spotlight, is the most expensive casket. The solid bronze, the hand-polished mahogany. They don't start with the simple pine box in the corner. They start with the $5,000, $10,000, $15,000 model. This is a classic sales tactic called anchoring. They set your price expectation high. Anything less now feels cheap. Then come the questions. They're not aggressive. They're gentle, subtle, and devastatingly effective. Your mother was a wonderful woman, wasn't she? This casket has a special memory drawer for keepsakes. Guilt. This model has a special rubber gasket seal. It's a protective casket. Confusion. A protective casket doesn't actually protect anything. Nature is undefeated. But in that moment, the idea of protecting your loved one is an emotional life raft. And you'll pay anything to cling to it. They'll show you velvet interiors, custom embroidered head panels, and corner plaques. Each one is an upgrade. Each one adds hundreds, sometimes thousands of dollars to the bill. And every decision is framed around a single unspoken question. How much did you love them? The more you spend, the more you love them. It's a brutal psychological trap. And it's not just the casket. It's the $1,000 vault the cemetery requires. It's the $500 for the flowers they provide. The $400 for the memorial book and prayer cards. The $600 for cosmetology and preparation. A fee that's often separate from the embalming you're already paying for. It's a death by 1,000 cuts. Before you know it, a simple dignified service has ballooned into a $20,000 affair. And you've agreed to it all in a fog of grief. You walk out with a bill that will haunt you for years, feeling like you had no other choice. But you do have a choice. And it's a choice protected by federal law. This is the secret. This is the piece of information that dismantles the entire process. It's called the Funeral Rule. Enacted by the Federal Trade Commission, the Funeral Rule is a consumer protection law that gives you rights. And the most important right is the right to see a price list. Not just any price list. A general price list, or GPL. This document must, by law, be given to you by the funeral director at the beginning of your conversation, before they show you any caskets, before they discuss any packages. You can ask for it over the phone. They have to provide it. You can walk in and ask for it to take with you. They have to give it to you. This document is the funeral director's kryptonite, because it itemizes everything. Suddenly, the magic is gone. The vague, bundled packages are broken down into their component parts, and you can see exactly what you're paying for. You can see that the casket you can buy online from Costco or Amazon for $2,000 is listed for $7,000 in their showroom. And here's the biggest secret of all. The funeral home must accept a casket you bought somewhere else, and they cannot charge you a fee for doing so. That's the law. Imagine the difference. Instead of being led into the emotional trap of the selection room, you walk in and say, "Before we begin, I'd like a copy of your general price list, please." The entire dynamic shifts. You're no longer a grieving victim. You're an informed consumer. You can take that list, sit down in the lobby, and calmly circle what you want and what you don't. You can say, "We will be providing our own casket. We would like a direct cremation. We do not need embalming. We will hold a memorial service at our church." You've just taken a $15,000 funeral and turned it into a $4,000 service, without sacrificing 1 ounce of dignity. You've taken the power back. So, what does this have to do with life insurance? Everything. Because a final expense life insurance policy isn't really about the money. The money is just the fuel. The policy is the vehicle that gets you to create the plan. The real product you are buying is that piece of paper. The real value is the conversation that a good agent facilitates before you're in the middle of a crisis. It's about sitting down with your spouse, with your kids on a calm Tuesday afternoon, and making these decisions in a state of logic, not a state of emotional distress. The insurance policy is the mechanism that funds the plan you've already made. It ensures your family doesn't have to use their savings or go into debt. But its true purpose is to give your family that single sheet of paper. A document that says, "Here is the name of the funeral home. Here is the plan we've chosen. Here are the things we want and the things we do not want. The funding is in place. Please just execute our wishes." When your family walks into that funeral home, they aren't walking in to be sold. They are walking in to place an order. It transforms the single worst day of their lives from a moment of confusing, high-pressure sales into a simple, dignified transaction. It's the final gift you can give them. Not money. Clarity. This plan, this one-page document, is the most powerful tool you can give your family. But how do you create it? What are the 3 critical questions you absolutely must answer on that piece of paper to make it bulletproof? Most people get them wrong, and it can invalidate the entire plan, leaving your family right back where they started. I'm going to show you exactly what they are. And the first one is the one almost everyone messes up. They write down a name. They write down, "My son John will handle everything." And they think they're done. But what they've just done is build a house with only one pillar holding up the roof. What happens if, God forbid, something happens to John? What if John is so overwhelmed with his own grief he can't function? What if he's out of the country? Or what if he and his sister, who you didn't pick, Have a massive falling out a year from now and she refuses to cooperate with him. The first critical question isn't who will be in charge. It's who is the line of succession. You don't need one name. You need a chain of command. You need a primary, a secondary, and a tertiary person. Think of it like a presidential line of succession. There is always a next person up. This isn't about trusting one person. It's about protecting the entire plan from a single point of failure. You need to write it down clearly. Primary executor John Smith. If John is unable or unwilling to serve, the role passes to secondary executor Jane Doe, and so on. By doing this, you've immediately removed the single biggest potential for chaos. You've answered the question before it can even be asked in a moment of crisis. You've prevented the first argument. But that leads to the second and arguably more frustrating question your family will face. This is the one that turns grief into a full-time job as a detective. Let's say John accepts the role. He's ready. He sits down at your desk, takes a deep breath, and says, "Okay, now what?" The question he's really asking is, where is everything? And I don't just mean where is the will. That's amateur hour. I mean everything. Where is the original life insurance policy document? Where are the bank account numbers? The investment statements? The password to your laptop? Where is the key to the safe deposit box and which bank is it even at? Where is the title for the car? The deed to the house? Do you have a small pension from that job you worked 30 years ago? Where is that paperwork? We live our lives accumulating these little keys and passwords and documents, and we keep a perfect map of it all in our heads. But that map dies with us, and our loved ones are left to wander in the dark. I heard a story about a family who spent 6 months of what should have been their grieving period, trying to guess the password to their dad's primary email account, because his entire financial life was tied to it. Every bill, every statement, every notification. They were locked out of his entire world. That's not a legacy. That's a nightmare treasure hunt where the prize is just getting back to zero. So on that piece of paper, you need to become a librarian of your own life. You don't have to write down the actual passwords. That can be a security risk. But you need to write down how to find them. The password manager I use is called LastPass. The master password is in the green envelope in my safe deposit box. A list of all financial accounts is on a USB drive labeled Finances in my top right desk drawer. The original policy for my final expense insurance is with my lawyer. Her contact information is. You are creating a roadmap. You are taking the detective work out of it so they can focus on what matters. Grieving, healing, and remembering you. This also includes your digital life. What happens to your Facebook account? Your iCloud photos? Your Google Drive with decades of documents? Do you want them memorialized, deleted, or passed on? These are assets just like a bank account. Not answering the where question is like leaving your family, a locked treasure chest with no key. The treasure is inside, but their pain and frustration will be in trying to pry it open. Okay, so we've established the chain of command and we've given them the map. Now we get to the part that causes the most emotional, family-shattering fights. It's the third question, and it's the one that final expense insurance is specifically designed to solve. The question is, how specifically do you want this to go down? Most people write, I want to be cremated or I want to be buried. Again, this is dangerously vague. It's an invitation for conflict. Let's play it out. You wrote, I want to be buried. Your son, John, thinks that means a simple, quiet service in a pine box because he knows you were a frugal person. Your daughter, Sarah, is absolutely convinced you'd want a grand celebration of your life, a beautiful mahogany casket, and a big reception for everyone to share stories. Who is right? Neither of them. And both of them. They both love you and are trying to honor you based on their own interpretation. But now they're not just grieving your loss. They're fighting each other. John thinks Sarah is being wasteful with the money. Sarah thinks John is being cheap and disrespectful to your memory. This one tiny unresolved detail can plant a seed of resentment that can tear siblings apart for the rest of their lives. Your final expense plan is the tool you use to prevent that fight. You don't just write burial. You write, I wish to be buried. I have a pre-selected plot at Oakwood Cemetery, Section 4, Plot 2B. I have spoken with Johnson & Sons Funeral Home, and I prefer the maple casket package. I would like a simple viewing for immediate family, followed by a public service. Please have someone read the poem Do Not Stand at My Grave and Weep, and I would love for the song Amazing Grace to be played. Do you see the difference? You haven't left a single thing open to interpretation. You haven't left a single thing for your children to fight about. You are using your final wishes to protect their relationship with each other. The insurance money is there to pay for it, but the instructions are what create the peace. You decide on the how so they don't have to. You make the tough calls so that in their moment of deepest sadness, they have a clear, loving set of instructions to follow, not a series of painful decisions to argue over. This brings us to the last and most important question. It's the one that elevates this piece of paper from a cold logistical document into a final profound act of love. You've answered the who, the where, and the how. Now you must answer the why. Why did you choose John to be in charge instead of Sarah? On that paper you write, I have chosen John to be my executor because he has experience in financial matters, and I wanted to spare Sarah that burden while she is grieving. Sarah, my love, this is in no way a reflection of my trust in you, but rather a final gift to you, the gift of peace. In one sentence, you've prevented a lifetime of perceived slights. Why did you choose a simple cremation instead of a big funeral? To my children, I have chosen a simple cremation because I believe a life is celebrated in how it's lived, not in the ceremony of its passing. I would rather you use any remaining funds to take a family vacation, create a new happy memory, and toast to the old ones. Your happiness is the only legacy I care about. The why is your final conversation. It's your chance to explain your thinking, to soothe potential hurts, to frame your final decisions not as preferences, but as acts of protection and love for them. It's where you tell them you're proud of them. It's where you tell them you love them one last time. Without the why, you just have a list of commands. With the why, you have a love letter. It's the final and most meaningful part of your plan. So you have the chain of command, the map to your life, the specific instructions for the final arrangements, and the heartfelt explanation of why you made those choices. This is the bulletproof plan. This is the document that ensures your final expense insurance actually does what it's supposed to do: create peace. But now comes the critical moment. The plan is perfect. The insurance policy is in place. The time comes and the insurance company sends a check. Let's say it's for $50,000. But there is a massive, devastating mistake that over 70% of beneficiaries make with that check the moment they receive it. It's a simple error born from good intentions and a lack of knowledge that can freeze all that money for months, sometimes even years, making the entire plan you so carefully built completely useless. I'm about to show you what that mistake is, and how one simple sentence written on your plan can stop it from ever happening. The mistake is a single word, written in a single box on your application. A word that sounds so official, so responsible, so correct. That word is estate. The single biggest mistake you can make on a final expense policy is naming your estate as your beneficiary. It seems logical, right? You pass away, everything you own becomes your estate. So the insurance money should go to your estate to pay your bills. It makes perfect sense on the surface. But in the world of law and finance, that one word triggers a nuclear bomb that destroys the very purpose of your plan. Because when you name your estate, you are not naming a person. You are naming a legal process. And that process is called probate court. Probate is the legal system's way of sorting out a person's affairs after they die. It's where your will gets validated, your assets are tallied up, your debts are paid, and whatever is left over is distributed to your heirs. And it is a nightmare. It is slow, it is expensive, and it is public. It's the one place you never ever want your final expense money to end up. Let me tell you a story about a man we'll call Robert. Robert was a retired mechanic, a grandfather of 3, and a man who believed in doing things the right way. He worked hard his whole life. He didn't have a fortune, but he was proud of what he had. He knew he didn't want his daughter, Emily, to be burdened with his funeral costs. So he did the responsible thing. He bought a $30,000 final expense policy. He made the payments every single month on time without fail. It was his final act of love for his daughter. When he filled out the paperwork, he got to the beneficiary section. He thought, well, this money is to pay my final bills, so it should go to my estate. He wrote in, the estate of Robert Miller. He put the policy in his top desk drawer and felt a deep sense of peace. He had taken care of it. A few years later, Robert passed away peacefully in his sleep. After the initial shock and grief, Emily remembered the life insurance. She found the policy in his desk and felt a wave of gratitude for her dad. He was still taking care of her even now. She called the funeral home, made the arrangements, and picked out a beautiful casket, confident that the $30,000 would cover everything. Then she called the life insurance company. She explained who she was and that her father had passed. The agent on the phone was very kind, very sympathetic. But then he delivered the crushing news. "Ma'am, I'm so sorry for your loss. I see the policy here, but we can't send the check to you. The beneficiary is listed as your father's estate. The money has to be paid to the estate's legal representative once one has been appointed by the court." Emily was confused. Appointed by the court? I'm his only daughter. I'm his executor. It's all for me anyway. The agent replied. "I understand, ma'am, but that's not how it works. The money is legally bound for the estate, and the estate is now under the control of the probate court. You'll need to hire an attorney, open probate, and get what's called a letter of testamentary from a judge. Once you send us that legal document, we can release the funds to the estate's bank account." Emily's heart sank. Hire an attorney? A judge? A special bank account? The funeral was in 5 days. The funeral home needed to be paid. She didn't have $20,000 just sitting around. She had to put the entire cost of the funeral on a high-interest credit card, completely wiping out her savings in the process. What Robert thought was a simple, loving gift had become a legal and financial nightmare for the one person he was trying to protect. This is what probate does. It takes the fast, tax-free private money from your life insurance policy and drags it into a slow, expensive public mess. The average probate process in the United States takes 9 to 24 months. The funeral home needs to be paid in days. Your mortgage or rent payment is due next month. The light bill doesn't wait for a judge's approval. And it's expensive. Emily had to hire a lawyer, which cost thousands of dollars. The court charges filing fees. There are fees for publishing notices to creditors in the newspaper. All these costs come directly out of the estate. So that $30,000 Robert so carefully saved? A chunk of it was immediately eaten up by the very legal process he accidentally triggered. By naming his estate, Robert turned his life insurance policy from a private contract between him and the insurance company into a public asset. And when an asset is public, creditors can make a claim on it. If Robert had any old credit card debt, hospital bills, or any other outstanding loans, those creditors could now line up at the probate court and demand to be paid from that $30,000. Before Emily saw a single dime, the entire plan was ruined. The money that was meant to give his daughter peace of mind in her darkest hour became the source of her greatest stress. All because of one word: estate. So, what is the simple sentence, the simple fix that prevents this entire catastrophe? It's not complicated. It's not a legal trick. It's simply naming a living, breathing human being as your beneficiary. Instead of the estate of Robert Miller, the form should have said, Emily Miller, daughter. That's it. That's the solution. When you name a person, the life insurance death benefit is paid directly to that person. It completely bypasses probate court. It is not part of the estate. Creditors cannot touch it. It's a private payment from the insurance company to the person you chose. Emily would have called the company, sent them a copy of the death certificate, and she likely would have had a check in her hand in a matter of days or weeks, not months or years. No lawyers, no judges, no court fees. Just the money, available immediately to be used exactly as Robert intended, to pay for his final expenses without causing his daughter a moment of financial stress. This is the most critical function of a final expense policy. Its value isn't just the dollar amount. It's the speed and simplicity with which that money can be accessed. Naming your estate sabotages both. Now you should always name a primary beneficiary. That's the first person in line to receive the money. But you should also name a contingent beneficiary. Think of this as the backup, the understudy. If your primary beneficiary, let's say your spouse, were to pass away before you or at the same time as you, the money would then go directly to your contingent beneficiary, perhaps your adult child. This provides another layer of protection, ensuring the money still avoids probate and gets to a loved one quickly. You could name your son John as the primary, and your daughter Sarah as the contingent. Or you could name them both as 50-50 primary beneficiaries. The flexibility is there. The key is that you are always naming people, not the process. Let me be crystal clear. Life insurance is one of the only financial tools in existence that allows you to transfer wealth, no matter how small or large the amount, to another person, instantly upon your death, with zero interference from courts, creditors, or the government. It is a unique and powerful privilege. Naming your estate as the beneficiary voluntarily gives up that privilege. It's like having a winning lottery ticket and deciding to throw it in the trash. Robert's story isn't an exaggeration. It happens every single day across America. Well-meaning people, who think they are doing the right thing, inadvertently create a tangled mess for their families because they don't understand the devastating power of that one little box on the application. They turn a solution into a problem. They turn a shield into a sword that their family has to fall on. The real meaning of final expense insurance is peace of mind. Not just for you knowing it's taken care of, but for the people you leave behind. It's about making the worst time in their life just a little bit easier. The difference between a check arriving in 10 days versus a legal battle lasting 10 months is the difference between peace and panic. It's the difference between your plan working and your plan failing. So the first, most important secret to making this work is to check your policy. If you have one, pull it out. Look at that beneficiary line. If it says estate, you need to call your agent or the company immediately and change it. If you're getting a new policy, make sure you name a person and a backup person. This single act is the foundation upon which your entire plan rests. Without it, everything else will crumble. Now let's talk about the second way a perfect plan can crumble into dust. It's a silent mistake, born from the best of intentions, but it causes more chaos and heartbreak for families than almost any other. It's the mistake of secrecy. You can have the perfect policy with the perfect death benefit and the perfect beneficiary named, but if that beneficiary doesn't know the policy exists or where to find it, it is functionally worthless. It's a ghost. A promise that can't be kept. Imagine this. A man named David, a wonderful father, works his whole life. He's meticulous. He pays his bills on time, saves a little, and he loves his daughter Sarah more than anything. He knows he won't be around forever, so he does the responsible thing. He buys a final expense life insurance policy. He makes his premium payments every single month on time for 17 years. He names Sarah as the sole beneficiary. He's done everything right. He feels a sense of peace knowing that when his time comes, Sarah won't have to worry about the funeral costs, the leftover medical bills, or the mortgage payment for that month. He's protecting her even in his absence. Then, one Tuesday afternoon, David has a massive heart attack and passes away unexpectedly. Sarah is devastated. Her world is shattered. In the fog of grief, she and her family start trying to make arrangements. The funeral director sits down with them and gently asks how they'll be paying for the service. The total comes to $12,000. Sarah remembers her dad mentioning something years ago about having life insurance to take care of things. But that's all she knows. It was a vague, passing comment. She has no idea what company it's with. She has no policy number. She doesn't even know for sure if he kept paying for it. So now, in the middle of the most painful week of her life, Sarah has to become a detective. She's not just grieving her father. She's on a desperate scavenger hunt. She's tearing through his filing cabinet, which is a mess of old utility bills, car repair receipts, and junk mail from 30 years ago. She's looking for a policy document, an old statement, anything with a logo. Nothing. She spends hours on the phone, calling every major insurance company she can think of. "Hi, my name is Sarah. My father David just passed away. I think he might have had a policy with you." Each call is the same. "I'm so sorry for your loss, ma'am. We'll need a policy number to look that up," which is the one thing she doesn't have. Meanwhile, the clock is ticking. The funeral home needs to be paid. The credit card company doesn't care that she's grieving. The bills are real. The stress is mounting, layering on top of her sorrow, crushing her. She feels a terrible mix of anger and guilt. Angry that her dad left her in this position, and guilty for feeling angry at a man she loved so dearly. He had the best intentions. He paid for that peace of mind for 17 years. But because of one simple omission, the failure to communicate, he had accidentally left her a legacy of chaos instead. Eventually, after weeks of searching, long after she and her family had to pool their own money and go into debt to pay for the funeral, she finds it. An old premium notice tucked inside a book on his nightstand. She makes the call, provides the policy number, and the company confirms it's active. The money was there the whole time. A wave of relief washes over her. But it's followed by a profound sadness for the unnecessary hell she just endured. This story is not an exaggeration. It happens every single day in this country. State governments hold billions of dollars in unclaimed life insurance benefits, simply because beneficiaries have no idea the money is waiting for them. The greatest plan in the world is useless if it's a secret. So what is the solution? It's not complicated. It's not expensive. It is perhaps the single most loving and organized thing you can do for your family. You need to create what I call an in case of emergency binder, or a folder, or a digital file. The format doesn't matter. What matters is that all the critical information is in one place, and your beneficiary knows exactly where to find it. This isn't just about your life insurance policy. This is the playbook for winding down your life. It is the ultimate gift you can give the person you've chosen to handle your affairs. So what goes in this binder? First, and most obviously, a copy of your life insurance policy declaration page. This page has everything in a nutshell. The insurance company's name, their phone number, and most importantly, your policy number. With this one sheet of paper, your beneficiary can make the claim in minutes, not weeks or months. Second, include the name and contact information for your insurance agent, if you have one. Your agent can be an incredible advocate for your family, helping them navigate the claims process and cutting through any red tape. They are a human guide in a corporate world. Third, a list of other important documents and where to find them. Your will, your trust documents, the deed to your house, the title to your car, your birth certificate and social security card. You don't need to put the original documents in this binder, but you need a clear, simple list telling your beneficiary where the real ones are. My will is in the safe deposit box at Chase Bank on Main Street. The key is in the top left desk drawer. Simple, clear, actionable. Fourth, and this is crucial in our modern world, a list of your digital life. Think about it. Online banking, social media accounts, email, streaming services, automatic bill payments. You need to leave behind a list of these accounts and securely the passwords. You can use a trusted password manager and share the master password, or a carefully written and sealed list. This allows your beneficiary to shut things down, stop automatic payments, and protect your digital identity. Fifth, your final wishes. Do you want to be buried or cremated? Is there a specific funeral home you prefer? Did you already prepay for a plot? Is there a special song you want played or a passage you want read? Writing this down removes the burden of guessing from your family. In their grief, they will be paralyzed by the fear of getting it wrong or not honoring what you would have wanted. By making your wishes clear, you give them the freedom to grieve without the added stress of making a dozen impossible decisions. And finally, the most important part of this binder, a personal letter. A letter to the people you love. Tell them what they meant to you. Share a favorite memory. Give them a final piece of advice. Reassure them that it's okay to be sad, but also okay to be happy again. This binder starts as a collection of cold, hard facts, policy numbers and passwords. But this letter, this is what transforms it from a financial tool into a final act of profound love. It is the last "I love you" you will ever get to say. Once you've assembled this binder, the final step is to have the talk. Sit down with your beneficiary. Pick a calm, quiet moment. You can start by saying, "I need to talk to you about something important. It's not because I'm sick or think anything is going to happen soon. It's because I love you, and I want to make sure that if something ever did happen to me, you wouldn't be burdened." Show them the binder. Explain what's in it. Tell them where you're going to keep it, in your desk, in a fireproof box, in your closet. Make sure your contingent beneficiary, your backup person, also knows where it is. This conversation might feel awkward for a minute or two, but that temporary awkwardness will save your family from unimaginable pain and stress later. You are replacing their future panic with present peace. You're not just giving them a folder of papers, you're giving them a roadmap through the darkest days of their life. You've named the right person and now you've handed them the map. And a map is useless if it's written in a language no one can understand. It's useless if it's missing the most critical landmarks. So what does this map, this legacy folder, actually contain? It's more than just the life insurance policy, though that's the cornerstone. Think of it as the operating manual for your life, handed over at the exact moment it's needed most. First, the obvious, the life insurance policy itself. A physical copy is great, but at the very least, they need the policy number, the name of the insurance company, and the direct phone number to their claims department. Not the sales line, the claims line. This one detail can save hours of frustrating phone trees while they're grieving. Next, a list of all financial institutions. Where do you bank? Where is your 401k or your IRA? Do you have a small investment account with an app on your phone? List the institution, the account number, and a contact person if you have one. Your family doesn't need to be guessing if you had an old account at a credit union from a job you left 10 years ago. They need clarity. Then comes the digital world. This is the part most people forget, and it creates a modern-day nightmare for families. You need a list of your critical online accounts and passwords, your primary email, your social media accounts, the login for the electric company, The cell phone provider. How do they stop the automatic payments? How do they access your email to find online bills or digital subscriptions you've paid for? Now be smart about this. Don't just write your passwords on a sticky note. Use a secure password manager and provide instructions on how your beneficiary can access the master password. Or use a sealed envelope, stored with your will, clearly marked for your executor. The goal isn't to be careless with your data now. It's to prevent a digital lockdown for your family later. You also need a list of key people. Who is your lawyer? Your accountant? Your financial advisor? Include their names, their firms, and their phone numbers. These are the professionals who can help your family navigate the complexities of settling an estate. Your beneficiary shouldn't be scrolling through your phone's contacts, hoping to find the right John Smith. And of course, the legal documents. Where is the original copy of your will? Your trust documents? The deed to your house? The title for your car? They don't all need to be in the folder, but the folder must state exactly where they are. The original will is in the safe deposit box at Main Street Bank, box number 123. The key is in the top left drawer of my desk. That level of detail. It turns a frantic house-tearing-apart search into a simple, dignified task. But here's where the map goes from being a financial guide to a final gift of love. The last section should be your personal wishes. This is where you get to have the final say. Do you want to be buried or cremated? Is there a specific song you want played at your service? A favorite poem you want read? Do you want people to wear black? Or celebrate your life in bright colors? Who do you want to speak? What do you want to happen to your social media profiles? Do you want them memorialized or deleted? These aren't morbid questions. They are a final act of guidance. You are lifting an impossible burden from your family's shoulders. Because the last thing you want is for your children to be standing in a funeral home, emotionally shattered, arguing about what they think you would have wanted. That argument, born from love but fueled by grief and stress, can cause rifts that last a lifetime. You can prevent that. You can give them the gift of certainty. Now let's paint a picture. Two scenarios. Two families living in houses side by side. In both homes, an elderly father, a man named Robert, passes away peacefully in his sleep. His children are heartbroken. The grief is identical. But the days that follow could not be more different. In the first house, Robert's son, Mark, is in a fog. He knows his dad had a life insurance policy for his final expenses, he'd always said. But where is it? Mark spends the first day, the day he should be processing his loss, rummaging through dusty file cabinets in the basement. He finds old car insurance cards, expired warranties, but no policy. He calls the big insurance companies one by one. We have no record of a Robert with that date of birth. He's guessing. He feels a rising tide of panic. The funeral home needs a deposit. They're asking about arrangements. Did his dad want a burial? He remembers a conversation years ago where his dad mentioned wanting a simple cremation, but his sister, Sarah, tearfully insists he always talked about being buried next to their mother. The tension is immediate. A disagreement over a memory becomes a fight. Days turn into a week. Mark finally finds a bank statement showing a small automatic withdrawal to an obscure insurance company he's never heard of. He calls them. He's put on hold. He needs a death certificate, which he doesn't have yet. Meanwhile, the bills are piling up. The mortgage is on autopay, but from which account? He tries to log into his dad's laptop to find out, but he doesn't know the password. Every attempt locks him out for longer. He feels like a failure. He's not just mourning his father. He's failing to manage his father's legacy. The grief is now tangled with stress, anxiety, and resentment. The final expense policy is out there somewhere, but it's a locked treasure chest and he has no key. The money that was meant to bring peace is now the source of a desperate, frantic hunt. Now let's look next door. In the second house, Robert's daughter, Emily, is also heartbroken. The grief is a heavy blanket. But her father did something different. A few years ago, he sat her down. He handed her a simple 3-ring binder. "This is the map, sweetie," he'd said. "When the time comes, everything you need will be in here." After the initial shock and the tears, she remembers the binder. She goes to the bookshelf where it's kept. She opens it. The very first page has the name of the insurance company, the policy number, and a direct number for the claims agent, a man named David. It says, "Ask for David." He knows our family. She makes one phone call. David is kind, compassionate. He tells her exactly what documents he needs and walks her through the process. The funds will be available in a matter of days. She turns the page. There's a list of bank accounts, a login and password for his laptop, kept in a small sealed envelope. Another page details his wishes for the funeral. It's written in his own hand. I want to be cremated. Please play What a Wonderful World by Louis Armstrong. And tell everyone to share a funny story about me. I want people laughing, not crying. Emily starts to cry, but these are different tears. They are tears of gratitude. Her father, even in his absence, is still taking care of her. He is guiding her. She calls her brother. There are no arguments about what Dad would have wanted. It's right there in black and white. They aren't detectives. They are executors of his final, loving wishes. They spend the next week not hunting for documents, but sharing stories. They laugh about the time he tried to fix the sink and flooded the kitchen. They cry together, remembering his kindness. Their grief is pure. It is not contaminated by financial stress or logistical chaos. They can focus entirely on honoring the man they loved. The final expense policy wasn't just money. It was the key that unlocked a peaceful goodbye. It was the foundation upon which they could build their grief, without the house of cards collapsing around them. That binder, that map, was Robert's final, I love you. It was his last and perhaps greatest act of being a father. He protected his family not just from the cost of a funeral, but from the chaos of the unknown. That is the real meaning. That is the true power you are putting into place. So how do we bottle that feeling? How do we take that profound act of love and translate it into a concrete plan for our own families? Because knowing the why is one thing, but building the how is what separates a good intention from a lasting legacy. And this is where so many well-meaning people with hearts of gold, make devastating mistakes. They're not mistakes of malice or neglect, but mistakes born from a lack of information, from the sheer noise and confusion that surrounds this topic. We're going to cut through that noise right now. We're going to talk about the 3 silent killers of a good final expense plan. The first, and by far the most lethal, is the monster of procrastination. It's the whisper that says, I'll get to it tomorrow. Or, I'm healthy, I have plenty of time. Or the most common one, I just don't want to think about it right now. And I get it. Nobody wants to confront their own mortality. It's uncomfortable, feels morbid. But let's reframe this. You're not planning for your death. You are planning for your family's life after you're gone. Every day you wait, 2 things are happening silently in the background. First, you're getting older. That's a fact of life. And in the world of insurance, age is the primary factor that determines cost. A policy for a healthy 60-year-old might cost $40 or $50 a month. That same exact policy for a 70-year-old could be double that. Waiting 10 years could literally cost you thousands of dollars in extra premiums for the exact same benefit. The second, more dangerous thing happening is that life is unpredictable. A sudden diagnosis, a change in health, an unexpected condition can appear overnight. And that can change you from being easily insurable to being difficult, expensive, or in some cases completely uninsurable. The door that was wide open yesterday can slam shut without warning. Procrastination isn't just putting off a task. It's gambling with your family's financial security, and the house always has the edge. It's leaving the most important love letter you'll ever write half finished. The second silent killer is what I call the wrong tool for the job trap. Imagine you need to hang a picture frame. You have a toolbox. Inside, there's a sledgehammer and a small tack hammer. Both are hammers. Both can hit a nail. But if you use the sledgehammer, you're going to destroy the wall, the frame, and probably your foot. It's the wrong tool for the job. This is exactly what happens with life insurance. Many people think, oh, I have life insurance through my job. That is wonderful, but that is almost always a term life insurance policy. Term life is the sledgehammer. It's designed for a specific massive job. Replacing your income during your working years to pay off a mortgage, fund college, and support your family if you die prematurely. But what happens when you retire or leave that job? The sledgehammer is gone. It disappears. And you're left with a small nail and no hammer at all, right when you need it most. Final expense insurance is the tack hammer. It's not designed to replace your income. It's a specialized, precise tool designed for one specific job. To be there immediately to cover funeral costs, medical bills, and other final expenses, no matter when you pass away. It's a type of whole life insurance, which means the price is locked in for life, and it never expires as long as you pay the premiums. Using a term policy for final expenses is like hoping your job sledgehammer will still be in your toolbox when you're 85. It won't be. You need the right tool, a permanent tool that you own and control, designed for the specific task at hand. The third silent killer is the most subtle. It's the set it and forget it fallacy. Let's say you were responsible. You did the right thing 20 years ago. You bought a small $10,000 whole life policy. You tucked it away in a drawer and felt that peace of mind. But here's the problem. The world didn't stop changing. 20 years ago, $10,000 might have covered the average funeral with a little left over. But today, the National Funeral Directors Association reports the median cost of a funeral with a viewing and burial is now well over $9,000. And that doesn't even include the cemetery plot, the headstone, or other cash advance items. That $10,000 policy that felt so solid 20 years ago is now barely enough. It leaves no room for final medical bills, an outstanding credit card, or giving your spouse a few months of breathing room. Inflation is a quiet thief. It slowly erodes the value of your plan. A plan isn't a one-time event. It's a living document. It needs a checkup every few years, just like you do. Are the beneficiaries correct? Is your ex-spouse still listed? Is the amount still sufficient to prevent your family from having to pull money out of their own pockets? Forgetting to review your plan is like plotting a course on a map from 1995. You might be headed in the right direction, but the roads have changed, and you're likely to end up far from your intended destination. So, how do we avoid these traps? How do we build a plan that is resilient, appropriate, and powerful? It comes down to a simple three-part framework: clarity, cost, and comfort. First, clarity. This is the most important step. Before you ever look at a quote or talk to an agent, you and your family need to get clear on what you want and what you need. This isn't just about the funeral. It's about creating a blueprint. Sit down and have the conversation. Do you want a burial or cremation? A big service or a small private gathering? Beyond the funeral, what other loose ends will need to be tied up? Are there small debts like a car payment or a credit card? Are there final medical bills that Medicare won't cover? Do you want to leave enough for your spouse to cover the rent for 3 months, so they don't have to make financial decisions while they're grieving? Write these numbers down. Add them up. This isn't a morbid exercise. This is an act of supreme organization and love. You are creating a roadmap for your family to follow during their most difficult days. This number, this blueprint, gives you clarity. It's your target. Second, cost. Once you have your clarity number, your target, you can find a plan that fits both your needs and your budget. This is crucial. The goal is not to be insurance poor. The goal is to find an affordable monthly premium that you can comfortably manage for the rest of your life. This is where you have to understand the landscape. You'll see ads for guaranteed issue policies that ask no health questions. These can be a lifeline for someone with serious health issues, but they always come with a 2 or 3 year waiting period. If you pass away during that time, your family only gets the premiums back, not the full death benefit. On the other hand, a simplified issue policy asks a few health questions. If you can honestly answer no to them, you can qualify for a plan that is less expensive and, most importantly, has day one coverage. The moment that policy is in force, your family is protected for the full amount. Understanding this difference is key to finding the right cost and the right value for your situation. Finally, comfort. This is the emotional payoff, the peace of mind. Comfort isn't just about having a policy. It's about knowing you have the right policy from a stable, reputable company that has a long history of paying claims. It's about knowing the process for your family will be simple. The check will arrive quickly, often within days, not weeks or months. It's the comfort of knowing that your daughter or son won't have to fill out 30 pages of complicated paperwork while they're trying to plan a memorial. They'll make one phone call. This is the ultimate goal. Not a piece of paper in a drawer, but a promise. A firm, unshakable guarantee that when the time comes, the chaos will be held at bay, and your final wishes will be carried out with dignity and grace, funded not by their grief-stricken scramble for cash, but by your foresight and your love. Clarity, cost, and comfort. That is the foundation of a plan that works. Now you know the mistakes to avoid. You have the framework to build a solid plan. But this leads to the final and perhaps most confusing question of all. With hundreds of insurance companies all claiming to be the best, all flooding your mailbox and television with ads, how do you actually choose one? How do you separate the marketing hype from the reality and find a partner you can truly trust to be there in the end? The answer isn't about finding a magic bullet or a secret little-known company. The answer is about a process. It's about knowing what to look for, so you can cut through the noise and make a decision based on facts, not fear. Let's break down that process into 3 simple, Non-negotiable pillars. If a company doesn't meet these 3 criteria, they don't even get to the starting line. First, and most importantly, is financial stability. This sounds boring, but it is the bedrock of the entire promise. You are buying a promise that a company will be there to pay a claim in 5, 10, maybe 40 years from now. How can you know they'll still be standing? You look at their report card. In the insurance world, the most respected report card comes from a company called AM Best. They've been rating the financial strength of insurance companies for over a century. They don't care about the commercials or the fancy mailers. They are financial detectives who dig into a company's books, their investments, their cash reserves, and how they handle their money. They then issue a grade just like in school. An A+ or an A rating means the company has a superior ability to meet its financial obligations. It means they've weathered economic storms, market crashes, and global crises before, and they have the capital to do it again. A C rating? That means they're vulnerable. Think of it like this. You wouldn't build your family's home on a shaky foundation of sand, would you? You'd insist on deep-set concrete and steel. An insurance company's AM Best rating is its financial foundation. Never ever build your legacy on a C-rated company, no matter how cheap their premium seems. The peace of mind you're buying is worthless if the company behind it crumbles. So rule number 1. Only consider companies with an A or A+ rating from AM Best. Period. The second pillar is history and reputation. In an age of startups that appear and disappear overnight, longevity in an insurance company is a powerful testament. A company that has been in business for 75, 100, or even 150 years has seen it all. They were there through world wars, the Great Depression, the dot-com bubble, the 2008 financial crisis, and global pandemics. They have a long documented track record of paying claims to families, generation after generation. They've proven their business model isn't a fad. It's a long-term covenant. This doesn't mean a newer company is automatically bad, but it means an older company has passed the ultimate test, the test of time. Their reputation isn't built on a single quarter of good profits. It's built on decades of keeping their promises. You can look at online reviews and consumer reports, and that's fine, but the real reputation is written in their history books. It's found in the millions of claims they have paid without fail, year after year. A long history demonstrates stability and a commitment to their policyholders that goes beyond a marketing slogan. They exist for one reason: to pay these exact types of claims. A company that has been doing it since before your grandparents were born is a pretty safe bet. They'll be there for your children. Now, the third pillar is where it gets personal. It's product and underwriting fit. This is the one most people miss, and it's critically important. Just because a company is financially strong and has a great history doesn't automatically mean it's the right company for you. Every single final expense insurance company has a different appetite for risk. They have different niches or sweet spots when it comes to health conditions. Let me give you an example. Company A might be fantastic for someone with well-controlled diabetes. They might offer them a day one immediate benefit at a fantastic rate. But that same company might be terrible for someone who uses an inhaler for COPD, maybe charging them a higher price and imposing a 2-year waiting period. Meanwhile, Company B might be the exact opposite. They might penalize the diabetic but have the most aggressive, best price policy in the country for someone with COPD. This is the hidden landscape of final expense insurance. There isn't one best company. There is only the best company for your specific age, health, and lifestyle. The company that advertises on TV has no idea if you have high blood pressure, or if you had a heart attack 3 years ago, or if you're a smoker. They're just casting a wide net. Choosing the wrong company, even if it's an A-rated one, could mean paying 30 to 50% more than you need to, or worse, getting stuck with a 2-year waiting period when another company would have approved you for immediate coverage. So, this brings us back to the original question. With these 3 pillars in mind, financial stability, history, and the right product fit, how do you actually navigate this? How do you compare dozens of A-rated companies to find the one that views your health profile most favorably? You don't do it alone. The secret isn't a what, it's a who. The key is to work with an independent broker. This is the single most important piece of advice in this entire series. There are 2 types of people who sell insurance. There are captive agents and there are independent brokers. A captive agent works for one company. Think of a State Farm agent or a New York Life agent. They are great people, but they can only offer you State Farm or New York Life products. They are a one-trick pony. If their company's underwriting isn't a good fit for your health, they can't help you. They're like a car salesman at a Ford dealership. They can sell you any Ford on the lot, But if the best car for your family is actually a Toyota, they can't sell it to you. An independent broker, on the other hand, works for you, not the insurance company. Their loyalty is to their client. They aren't captive to any single company. Instead, they have appointments and contracts with dozens of the top-rated insurance carriers in the country. They are like that master car broker who can get you the Ford, the Toyota, the Honda, or the Chevy. They listen to your needs and then they go out and shop the entire market on your behalf. When it comes to final expense, a good independent broker who specializes in this market knows the underwriting niches of every major carrier. They know which company is best for diabetics, which one is best for heart conditions, which one is best for smokers. They can take your unique health profile and instantly compare it across 15 or 20 A-rated companies to find the one that will give you the best possible offer. The lowest price and the best terms, usually with immediate day one coverage. They do the hunting for you. They cut through all the marketing hype and get straight to the facts. They can find in 10 minutes what would take you 100 hours of research to maybe possibly figure out on your own. This isn't about a sales pitch. This is about strategy. This is about putting a professional in your corner who has the tools and expertise to navigate a complex system designed to be confusing. So as we bring this journey to a close, let's bring it all back home. We started this series talking about what this is really about. It's not about a check. It's not about an insurance policy. It's about a final act of love. It's about that daughter who got the call about her father and whose first thought could be about her grief, not about a GoFundMe page. It's about that husband who could honor his wife's final wishes for a beautiful service without draining their life savings. It's about dignity. It's about peace. It's about closing a final chapter with grace and foresight. The decision you make isn't just a financial transaction. It's a message that will be delivered to your family on one of the worst days of their lives. That message can be one of chaos, stress, and financial burden. Or it can be a final whispered, "I love you. I took care of everything. You just worry about healing." You now have the knowledge. You know why this matters. You know how it works. And now you know how to choose. The power is truly in your hands. Find a trusted, independent specialist. Let them do the heavy lifting. Get this one final piece of your financial house in order, so you can put it on a shelf, know it's done, and get back to the business of living your life to the fullest, with the profound peace of mind that comes from knowing you've protected the people you love, no matter what. That is the real meaning of final expense. It's the last love letter you'll ever write.